behind this webinar, isn't there?
There is. It's this particular webinar has been 2 years in the making. For our more loyal fans, you would have tuned in, I believe 2 years ago, close to the date when we did our first Ask Us Anything webinar with all your ETF questions. There's been high demand for another one. We finally got it past our legal and compliance department, so we're back to answer all your ETF questions.
That's right. Yeah, I must say it is very good to be back here in this room, Tom, answering some of your questions. So the structure of today is we'll basically go through a number of questions that you guys have sent in the past sort of couple of weeks, and then we'll also do a bit of a quick fire round as well. And then finally, we're going to allocate sort of 10 to 15 minutes at the end to answer some of your live questions as well. So what you'll be able to do is actually you can ask questions through GoToWebinar, and we'll see those questions and we'll leave it till the end and answer and go through some of them. So encouraging you basically to ask any questions that you might have. And just before we start, Tom, the obligatory disclaimer.
Of course.
Anything we say here today is not personal financial advice. So just keep in mind that when we are answering these questions, it's general in nature answers we're giving. We don't know your personal financial situation, and therefore we're not going to be giving any personal financial advice. So we're going to stray away from, recommending ETFs or anything of the sort.
Very well done. That's more comprehensive than I usually am, so we've done well. And if in doubt, please read the disclaimer on screen.
There we go. It's up on screen now. And so without further ado, Tom, let's just get right into it.
Let's dive in.
So the way we'll structure this, we're just going to do an initial section. These questions are your most popular questions that you've asked. So for most of these, we've had 3 or 4 people asking the same thing, so really high demand. And Tom, to start us off, what are the best things to look for when deciding on an ETF to invest in for long-term financial gain versus the short-term? And what are some of the most common mistakes that investors make when they're investing in ETFs?
Okay, big one off the bat.
Huge
right
question.
into it. It's kind of 2 questions in one here, so I might break it out. First question is about investing short-term versus long-term. How do we decide how long to invest for? The second question is around common mistakes. So look, it's a really good starting point because all of us as investors, we need to think of the starting point. And for me, the way I think of it is what is the goal of your investment journey? Why are you investing? Are you investing because you're a younger accumulator and you're putting money away for 30, 40 years? Are you potentially an older investor? You're investing closer or into your retirement to try and earn income and draw down your capital. And once you understand why you're investing, it can really help to answer a lot of your investing questions, including investing for the long term versus the short term. So typically, if we go back to that example of the type of investor you are, maybe I'll ask Ben, where would you sit yourself on that scale?
Well, I think I'd probably be what you call an accumulator. So maybe on the younger end, I'd like a house one day. So maybe I'm saving for a house.
Sure, and let's say 10, 15 years away.
I hope so. I hope so.
Without, of course, not taking into account your personal details.
Of course, yeah.
But just so a young accumulator maybe like Ben, who's investing for the long term, well, we know that you can have a higher risk tolerance. If you're investing for a longer time frame, you can deal with volatility in the short term, which means you can probably focus more on equities, focus more on diversified equity exposure, and you're not too worried if in a year or 2 years' time, your money is actually decreased in that period, because that's very possible over the short term. Over the longer term, the longer we invest for, the longer we typically have, or the more we typically hedge away that time risk, particularly if we're investing in intervals along the way. So I guess back to the question, investing long term versus short term, it really comes down to your overriding goals. What are you investing for? Look, if you're investing to try and make a really short term gain, you have to understand that could also be a really short term loss. So that's that half of the question. Good start, good first half.
Yeah, very, very comprehensive, Tom. This is what 2 years of investment strategy experience.
2 more years of Betashares, and we're longer answers than ever. And the second half was common mistakes people can make when investing in ETFs. The one I want to highlight here is to do with timing the market. There's a very famous quote, I don't know if it's a quote or a saying, that goes, it's all about time in the market, not timing the market. And what that means, it's about investing and investing over the long term to get gains. and not trying to pick and choose when the market will do well or do poorly. There's a lot of research out there, Ben. We've done a lot of research here at Betashares into it. There's a really good insight actually on our insights page on the website that talks about the difficulties of timing the market and actually the results of timing the market. And what I found really interesting from this piece was if you gave different investors the same sum of money, the investor who put their money in on the first day of the trading year or the investing year compared to the investor who picked the market perfectly that year, the difference in their end outcome after 30 years was actually surprisingly small. I feel like personally you can do a lot more harm than good in trying to time the market. What about you, Ben? Any common mistakes that you'd want to raise?
Yeah, I think that's a great point, and I think you and I have both been fallen victim to trying to time the market on penny stocks or on ETFs or whatever. But we sort of practice what we preach now. Yeah, I think that's probably the most common mistake that I see. I think another one is just not understanding what's in the ETF that you're holding. You always want to make sure, and it's always available on the fund webpage, but it's really important that you understand what you're actually buying when you buy an ETF, because it's become such a seamless process now, right? You can just go to your broker, something like Betashares Direct, you can just type in an ETF, tick a code, and then you can buy it. But it is really important to understand the holdings, understand what you're getting exposure to.
Yeah, it's a great point. It almost wraps the whole question up nicely. You got to know why you're investing, do your research, understand what's going on, and then trusting in the long-term process of investing.
Definitely, yeah, definitely.
Yeah, great. That's what a great kickoff.
Great question.
We'll go to the next one. Another one of the ones we got multiple times and get all the time, so worth covering off on at the top. So the question is, Ben, ETFs versus managed indexed fund or funds. What are the pros and cons of each type?
Yeah, we get this one a lot as well, and it can be a bit confusing. Maybe just to start us off, it's worth distinguishing that ETFs, index funds, and managed funds, it's sort of a bit of a Venn diagram, so there is some overlap. And what I mean by that is that a lot of ETFs are also index funds. And when I say index funds, I mean that they aim to track an index. And so a lot of our ETFs that we offer are tracking indexes, so they're passive. I think maybe what this question is referring to is ETFs versus managed funds, which is your unlisted funds. And so ETFs are obviously traded on an exchange, so you can buy it and sell it just like a share. And that comes with a lot of distinguishing points from unlisted managed funds. So for starters, ETFs are a lot more liquid, which means that they trade more frequently than unlisted funds. So if you imagine, if you want to buy an ETF, you can sort of do that very seamlessly. You can be holding those assets legally within 2 business days. Whereas with an unlisted fund, you have to go to the fund manager, you have to do a bit of paperwork. There's a bit more administration, Tom, which is not what we like here at Betashares. And so that is one of the key factors there. Tom, any other factors that you think?
The way I like to think of it, when you're talking about an ETF versus an unlisted fund, they're both just investment vehicles. They're both structures that kind of allow you to invest in whatever's underlying them. I think what's really telling at the moment is what we're seeing. Well, actually, before I get to that, sorry. So a managed index fund, unlisted fund, and an ETF can actually hold the same underlying. They can have the exact same investment exposure. There are just certain advantages which Ben touched on that you have from being in an ETF and being listed on the exchange. And what I was going to say, what I think is really telling at the moment is traditionally a lot of the managed funds that were quite popular were actively managed funds that were unlisted, active managed funds. And we're seeing a really large trend at the moment of those unlisted funds transferring to ETF structures. So you can have actively managed ETFs, and we're seeing a lot of managers transfer over. So the question of ETF versus unlisted is not the same as active versus passive. It's more to do with their merits as investment vehicles. But I think you summed it up very well, Ben.
It's pretty telling, Tom, that a lot of active unlisted funds are becoming ETFs. But yeah, I think if you're worried about these newfangled ETFs, although they're not really that newfangled anymore, it's worth remembering that the structure is, as Tom said, it's just a wrapper. It's just a structure for the underlying holdings, and so you don't have to be afraid of ETFs because they are actually mechanically quite similar to unlisted funds there. And so, Tom, this is another one we get a lot.
This is a perfect segue from you. You set this up.
Set you up
Yeah.
for what is a very frequently asked question, and the question is, how safe are ETFs?
Yeah, very important question. And when I hear that question, two things come to mind. The first thing that comes to mind is to do with regulation. You know, are ETFs regulated? How they're regulated? What happens if an ETF issuer goes out of business? And the second thing that comes to mind is, how safe is any individual ETF in terms of its investment risk and return characteristics? So I'll tackle those two separately. So firstly, on the regulatory side, luckily, Ben, well, not luckily, but yeah, luckily, Ben, because I myself am an ETF investor. I know you are too.
Yeah.
They come under some of the strictest forms of regulation in Australia for unit trusts or for investment trusts. As Ben mentioned, they're the same structure as a managed fund in terms of that unit trust structure. To put it in layman's terms, to make people feel comfortable, the most common question I get and the most common answer I like to give is, what would happen if Betashares or another ETF provider went out of business? You've got your money in Betashares ETFs. I've got my money in Betashares ETFs. Betashares go out of business. What happens? Do I lose my money? The good answer is no, you don't. The assets underlying ETFs, they're held by a third party custodian for the benefit of the unit holders themselves. So in that situation, when an ETF company went underwater or went bust, what would happen is the assets in that ETF that are held separately, those would be sold down separately, and then a distribution would be made to the end beneficiaries, the unit holders. But it is a very important topic, and I think people are very, very comfortable with ETFs now. I like to think of it goes through cycles, and ETFs in the US became very popular, or more popular, after the GFC. There's this real test period for ETFs, and they made it through and did very well. In Australia, we had a really interesting test period in COVID. We saw a market crash, and ETFs performed how they should have, and that also gave a lot of maturity to investors as well.
Yeah.
Now, on the second part of that question, as I see it, how safe is any individual ETF from a risk return profile? Well, Ben, as you know, there's no one answer to that question. Every ETF is different in some way. Some are very similar, but they're all different in some way. You can have ETFs that invest in high interest cash accounts, ETFs that invest in Australian equities. You can have leveraged ETFs, even ETFs that invest in crypto assets. So each of those, we've just gone across a whole spectrum of risk and return profile. So it's very important to look into each individual ETF from an investment standpoint as well.
Yeah, it depends.
It depends.
It depends is a great answer.
I should have just said it depends and moved on.
Yeah,
you can say it all the time.
Legal team would love that. Yeah.
Okay, so next one up, we have another common question here, which is it's a good question. I like this question. How are ETFs compiled or produced? What is the seed for the idea, Ben? Who's sitting in a room in Betashares and just thinking of these great ideas to come up with 94 funds now?
Yeah, where do ideas come from?
It's
a tough one.
It's a larger question.
So I mean, sometimes it feels like that. It's like where do these creative people come up with these amazing ETFs? Or in the US, there's some really crazy ETFs. Where do these ideas come from?
Yeah.
I think at Betashares, we can only speak for Betashares. The process is really collaborative. And so everyone is able to sort of give their input for an ETF idea, and that's always considered. So, absolutely anyone can suggest an ETF idea. It's not just one man in a room who's coming up with all the ideas. Obviously, from that ideation, getting it to market is a bit more of a rigorous process. And I would say some of the things we look at are long-term investment trends and the economic environment, and also what investors are asking for inside of their portfolios. So we're really trying to match the market demand for these ETFs. And maybe I'll give you an example, Tom. The duration hedged ETF that we launched last year. So that's a bond fund, and we've basically removed most interest rate risk from that ETF using some very complicated financial instruments. But to put it short, the way that that ETF came to be was that our fixed income desk, they saw, look, interest rates are rising rapidly. That's hurting the capital value of bondholders' portfolios, because as we know, as interest rates move up, the price of bonds go down. And so the fixed income desk said, look, I think we need to create an ETF that helps remove some of that risk. And so you can see how we brought something to market there that was really applicable to investors' portfolios.
Yeah, great solution, relevant to the market. And it's so true. Ideas can come from so many places, be it people or the market. Even some of our investors have given us ideas in the past that we've explored into bringing out ETFs.
Yeah, definitely. We're looking forward to launching another 100 ETFs in the next few years.
Must get thinking.
Yeah, send in your ideas in the question box. I can see we've got a few coming through now.
Questions coming through. As mentioned, we'll get to those questions. We'll try and get to as many of those questions and comments at the end. So please put them through, and we'll save some time at the end to get through as many as we can.
Definitely. So moving on, Tom. So now we've got some questions around ETF mechanics. So this one was also one of the most popularly asked questions.
Yeah.
But ETF mechanics, what's the nuts and bolts of ETFs? How do they actually work?
Sure.
When you're hitting buy, what's actually going on there?
That's not the question.
That's not. Okay. Sorry, that's not the question.
That'd be a long.
But this first question is, who or what determines the unit price of an ETF?
Sure. Okay. So the who are the market makers, and the what is the underlying assets. And I'll dig into each of those. So the who, as I mentioned, market makers. So market makers, these are large financial institutions. So investors might be aware of Citigroup. They might be aware of JP Morgan. These two large financial institutions have a market-making arm to their business to help the ETF process go around. And so their role is to price the ETFs essentially during the day for trading. So before the market opens, us as Betashares and other ETF providers, we will publish the underlying holdings of our ETFs. So we'll say, for this ETF, these are the, let's say it's an equity ETF, these are the companies we're holding, and this is the weight we're holding them in. And the market makers will use that information, and during the trading day when the ASX is open, they'll be looking at the shares we're holding, the percentage we're holding in, and based on that, we'll price the ETF appropriately. That's a simplified way to answer it. I'm not sure, but is there something you want me to dig a little deeper into on there, or do you think that's good enough for that purpose?
I think it's a good answer. Maybe just, I think, well, I know, but maybe if you just want to share a bit about the best times to trade and like market makers, can we expect them to always be there?
Yeah, important question. So we would advise, we do typically advise to not trade during the open and close of the market if you can avoid it, because the open and close times, the open and close offers on markets can be more volatile. It can be harder to price those underlying baskets as things are moving around quite rapidly. So during those periods, you might not want to trade ETFs. Sometimes market makers will set wider spreads on the screens. There'll be a wider spread on the bid and offer to compensate for that volatility. Typically, once the trading day is underway, once that volatility has subsided, you would generally get better, more smooth pricing via ETFs.
That's great. So just summary points there: market makers, financial institutions, they price the ETFs and give liquidity to the market.
Yeah, that's good. I guess one thing I might have skipped over is the creation redemption process. I'm not sure if we come to that later on in our questions. Maybe we'll dive into the next question, and if that comes up, we can
touch on that.
We can bounce off it. Great. So next question, and this is the first question that wasn't in that most popular category, so I can shout out David for asking this one. Thanks, David. David asks, could you please explain in simple terms the participants in an ETF and what their function is? Now, David's given us a list of who he wanted us to answer. I think you'll answer all those anyway, Ben, so I'll let you take it away.
Yeah, it's a good list, very comprehensive, David. I think you've basically got them all. To start with, so the provider, so Betashares, obviously. So we are the responsible entity of our ETFs, and that really means we're responsible for those ETF units. It's in the name. And a big part of that is we decide on the investment strategy that the ETF has. We make sure that the ETF is following that investment strategy. And we also sort of just oversee the whole management of that process. And so obviously all of our ETFs they're Betashares branded, and so we do the job of taking them out to market and telling you guys about our ETFs. The next one is the market maker. So as Tom sort of alluded to earlier, the market maker's job is to create and redeem units in the ETF. So they basically come to Betashares and they will create new units in the fund, which are then distributed to everyday investors like us. And so we are then trading with the market makers. So it's this symbiotic relationship between Betashares and the market makers. A couple of other key ones that David has pointed out here. So the custodian. The custodian is the group that holds the actual underlying assets of the ETF. And so the reason why they do this is they're able to keep that in a very separate ring-fenced account. And it means that Betashares or the market makers, for example, they can't just sort of dip their hands in and take that money away. It's always in a separate, safe, custodial account. So these guys, they're like the guardians of the ETF assets, if you will. Maybe I'll just touch on a couple of more. So the fund administrator, these are the people who they do the fund accounting, they calculate distributions, and sort of do the more administrative work. The admin, yeah, makes sense. And then finally, the registry, the unit registry, which you guys should be familiar with. One of the big ones is Link Market Services. They're who we use for our ETFs, and they're the ones who keep a registry of the number of unit holders, and they also help give out those distributions. I think I missed.
That's pretty good. One that I mentioned that it is a party in the realm of ETFs, but maybe not as direct, which is why you wouldn't have mentioned them. Is just the actual platforms themselves. So I remember back when we started, Ben, a number of years ago, and we were on the retail line. Just to plug it, anyone at home can ring up with any questions at any time that they have to the retail line and ask someone like me and Ben to answer these questions. And one of the most common questions we got was actually, how do I buy your ETFs? Where do I find these ETFs? As we've mentioned a few times already, they're ASX listed, which means you can buy them through a platform, an investing platform. Like Betashares Direct, the one we mentioned, Betashares now offers an investing platform. So that's a party in the sphere of ETFs. I think it's important to mention as well.
Yeah, definitely. Yeah, that's, arguably the most important part for a lot of investors. How do you actually buy the ETF?
Exactly.
Yeah. Great. So thanks so much for that question, David. Next question is from KB. So Tom, if you want to grab this one, can you please explain the mechanics of rebalancing the ETF?
I can.
That's great.
So it's going to differ for each ETF. There's a few key things I want to cover with this question. So with rebalancing ETFs, as we mentioned, the ETF, the exchange traded fund, is the structure. Now we're talking about what's below that structure. So we're talking about individual ETFs. I'll use an example here for ease. So if you've got a broad market index ETF, something like a Australia 200 ETF or an S&P 500 ETF, what you'll typically find is those broad market indices will rebalance quarterly and will rebalance based on the underlying company's market capitalization. What that means is it's that Australia 200 ETF, that'll pick the 200 largest companies listed on the Australian Stock Exchange generally, and then weight those according to their size relative to one another. Now, what's really important is you can find out this information for each ETF, for each passive index ETF that is, Ben, within its index methodology. And this is where KB, you can go to find out some of the nitty-gritty parts of each ETF and each index that it's tracking. Because within the methodology, it'll tell you exactly the rules that it sets out to choose the underlying companies and the weights of the underlying companies. Now, KB did ask for a specific example, I don't know, of one of our funds, Hack. Should we go into that level of detail, Ben, or just allude people to the website? I can cover it.
I think yeah, we've got some time, Tom. So maybe let's. So yeah, just for context, Hack is one of our ETFs. The ticker is Hack. It's a cybersecurity ETF.
Great ticker.
Great ticker.
One of the great tickers.
How would that rebalance?
Yeah, so it's a good example because just before I explained quite a simple methodology. You pick the largest companies, you weight them by their weight. That's quite simple, but there can be more nuanced rebalancing strategies and more nuanced strategies for picking the companies underlying an ETF. like I'll pose a quick question. If you out there were to create a cybersecurity ETF today, how would you think about selecting the underlying companies and weighting them? It's not instantly intuitive. What we do with Hack, with our cybersecurity ETF, we partner with a data specialist, with a specialist called the Consumer Technology Association, the CTA in the US. These guys have a lot of great IP, and what they do with a huge universe of technology companies, they categorize, or they identify which companies fit within the cybersecurity sphere. So that's the starting point. We work with the CTA, and they say these are all the companies globally that we classify as cybersecurity companies. We will then select the companies that classify for that, that also then meet certain liquidity requirements, certain size requirements, and certain trading requirements to make sure they're liquid enough so we can buy them, so we can run the ETF. And then it comes to the actual weighting and the rebalancing of the ETF. Now this one's interesting in a way. So what we do is we firstly weight all of the stocks based on their market cap, but we set an 8% stock cap limit. So no one company or no one stock can have more than 8%.
Yeah.
And then if that covers the first top five companies. So the top 5 companies can only be weighted at 8% maximum. After the top 5 companies, there's a 4% stock cap.
Yeah.
So it's almost this tiered system. And then lastly, we just make sure no company has less than a 0.25% weighting.
Yeah.
Now, all of that might sound a little complicated, a little in the weeds, which I think it's important to get into the weeds in a webinar like this. Why do we do all of that? Ben, is probably the important question, and it's to do with the viability of the ETF, to make sure it's tradable, make sure it's liquid, and it's also to do with capturing the investment theme in a way that we see fit. So for that example, we don't want one company having too much of a weight. Imagine if one company had 50% of the weight in the portfolio.
Yeah.
We're not too well diversified. So that's why we set those certain stock caps as an example.
It's a very comprehensive answer, Tom.
We got into the weeds.
Very good, yeah.
Thank you for that one, KB. We'll move forward. One for you, Ben, from Kylie. Kylie has asked, what is it I actually own when I buy an ETF? Is it any different to a share in a company?
Yeah, another great question. Thanks for that, Kylie. Look, I think the key difference, and there is a difference here, when you buy an ETF unit, you're getting exposure, or you get the rights to that ETF unit. And now within that ETF, it could be a number of shares or a number of bonds, but you're basically getting a little piece of that. And so each unit is sort of a little piece of a broader ETF. With shares, when you're buying a share, you go onto whatever trading investing platform you have, and you choose to buy a share, you get the ownership rights to a piece of that company. So the difference there is obviously a piece of a company versus a piece of an ETF structure. And so really one of the key things there is that with this ETF structure, it's not just one share, it's not just one company that's domiciled in one place and has one sort of style of operations in one geography. What you're actually getting exposure to can be a number of different shares or a number of different bonds.
Yeah, that's very good. I like to think of it, there are similarities and there are differences. And you've done well to touch on a lot of them. The similarities, they both trade on a stock exchange. In the case of our ETFs, the ASX, you can buy company shares or units in an ETF in the ASX. That's one similarity. When you buy a share in a company and when you buy a unit in the ETF, now it depends on the company, it depends on the ETF, but you're often buying it for some amount of either capital growth or income or a combination of both. So that's a similarity. But as Ben also touched on, there are those key differences. When you buy a share, you're buying a share of a single company. When you buy a unit in the ETF, you're buying a unit of an underlying pool of assets, which has great diversification benefits. But yeah, I think that sums it up.
Sums it up
nicely.
I hope that answers your question, Kylie. So Tom, this one's for you. I've given you all the tough questions.
Fair
Tom.
enough.
This is actually a really interesting question. And so Michelle, thank you for the question. Michelle asks, I have heard recently that the main reason that ETFs exists is to collect fees. Can you please speak about the fees and why they may be ongoing? Do all ETFs incur ongoing fees? even if they're bought on platforms like CommSec, surely having to pay these ongoing fees that erodes profit.
Many thanks.
Thanks.
Thanks, Michelle. That's 4 questions in one, but I'll do my best to answer them and to break it up. I really like the way Michelle's worded the first question. The main reason ETFs exist.
Very existential.
I took it quite existentially.
Yeah.
Why do ETFs exist? What is their purpose? I like to think that ETFs exist. Obviously, there's to collect fees, but I'll get there through this long-winded philosophical answer. I think ETFs exist not purely to collect fees, but I think ETFs exist to provide really good access vehicles and to help democratize investing. ETFs offer most people who have access to the internet access to diversified pools of assets, which is incredible, unthinkable 30 years ago. It's really helped me in my investing journey. Now, as a function of that, as a function of ETFs existing, they do charge fees. They do charge ongoing fees, as Michelle has asked. So that means each year or each day even, a small fraction, depending on the fee of the ETF, comes out of those returns. Why is that? Why do ETF charge fees at all? And why do they charge ongoing fees? Well, I guess to provide these ETFs to people, us, Betashares as a business, I can talk on behalf of the entire ETF industry. We incur costs to do so. We have to manage the ETFs. We have to make sure they're doing what they say they'll do, make sure the trading is going properly underneath the ETF. We have to put out new ETFs. We also do marketing. We do webinars from time to time. So each of these things is obviously a cost, and that cost is ultimately recouped from us through ETS fees. That's our main source of revenue, it's fair to say. Now, please stop me at any time. It's going to be a long answer. There's a lot to
carry on, please.
Carry on.
Yeah.
Carry on. So I'm going to go into now. Different ETFs have different levels of fees. Why is that? The Australia 200 ETF I've alluded to a few times on this webinar so far. The fees on that ETF are 0.04% per annum.
What is that for the layperson out of interest?
For the layperson, let's say you invested $10,000 for a year. That would equate to $4. $4 for every 10,000 invested over that year. So compared to historical unlisted and some active funds, they can be quite low. Look, I've used that example maybe a bit unfairly. That is our lowest cost ETF. Look, we've got ETFs that are priced all the way from that 4 basis points up to and above 1%, which would be $100 for every 10,000 invested per year, which is a big difference. Why do these fees differ? So fees will differ on ETF for a number of reasons. The complexity of the ETF, the complexity of what we're providing. That Australia 200 example, it's not too complex. The methodology is quite simple. If you have, let's say, a thematic ETF like HACK that we just talked about, you've got the CTA providing their IP, that costs a little bit of money. You've got that more complicated rebalancing structure. You've got equities from all over the globe, which is a bit harder to manage as well. These types of things add costs to ETFs, and that is why you'll see different ETFs with different fees. Now, I think I've covered. How do I go about it? Is there more on that one from Michelle?
Yeah, that's really comprehensive on the fee front. Maybe I'll just touch on. So paying ongoing fees erodes profit.
I missed that part.
Yeah, and I mean ultimately, look, the fees are taken out of your investment amount, but what it's important to consider is a lot of the time these fees are really very marginal compared to the potential returns. So maybe I'll just give an example. The NASDAQ, Tom.
Yes.
What is the NASDAQ sort of return in the past 10 or so years on average?
So the NASDAQ 100, past 10 years in Australian dollar terms, you're talking about 20% per annum. 20%,
so definitely a higher risk, higher return.
Yes, higher risk
index there.
Potential,
And so for an ETF, our ETF charges 0.48% on that amount.
0.48,
So you can see how even though something like the NASDAQ ETF has a higher fee than the Australia 200 ETF, you could say, it's 10 times as expensive. it's also worth taking into account that the returns that you might potentially get on a high growth exposure like the NASDAQ ETF can completely outweigh that.
More than offset the fee. Yeah. I think maybe it's another segue off that. It's important to fees are one important consideration when comparing ETFs, but not the only consideration. For myself personally, if I was thinking of including the NASDAQ 100 in my portfolio versus the Australia 200 fund, there'd be a lot of other considerations outside of fees. Things like, do I want domestic or international investment exposure? Do I want to be exposed to large cyclical companies like we have in Australia, or large technology companies like a list on the NASDAQ? And so there's a lot of decisions to consider for that portfolio implementation.
Yeah.
Fees are one of them. And I think fees can be more important when you're comparing like for like funds.
Yeah, definitely, with similar exposures.
Exactly right.
Yeah.
So that was Michelle. Thanks again, Michelle. Really good, comprehensive question on fees. Hopefully we covered it.
Long answer as
everything
well.
you're after. Next up is Michael. And Michael would like to know, Ben, or Michael has said, sorry, my understanding is that an ETF on, say, the ASX 200 is essentially tracking the market like an index fund. So is there any difference between an ETF with Betashares or anyone else? This is actually a good segue from what we just said, I think.
Yeah, 100%. Thanks for the question, Michael. So yeah, you are essentially right. There are a lot of ETFs now in Australia, right? And some of those ETFs do track similar exposures. So the largest 200 shares listed on the Australian Securities Exchange. There's a lot of ETFs that do quite a similar thing there. And in those cases where the exposures are very similar, there's maybe a couple of things you can look at. The first one is the fees, as we mentioned, for similar like-for-like exposures.
Sure.
Fees are a good indicator of, how much you're going to get charged every year from your ETF investment. You can also look at things like how reputable is the business that is offering these ETFs. So a company like Betashares, we've been around for a while now, and so maybe we're considered trustworthy within the ETF industry. So I'd say those are two key factors, but it's also important to caveat that just because an ETF says that it has the same exposures doesn't necessarily mean that it uses the same index methodology, has the same number of holdings, or has the same weight. So for example, there are a few quality factor ETFs listed in Australia. They're not necessarily identical. So it's really important just to make sure that, again, you understand what is in the ETF. And so you can go to the fund webpage and just scroll down to the relevant part of that where it has the holdings, and you can actually see every single individual holding and the weight within the ETF. So that's a great way to just do a litmus test when you're comparing two different ETFs.
Yeah, exactly. And one of the great advantages of ETFs generally, and this comes back to something I mentioned earlier, the democratization of investing, as I term it. They're really transparent. All the information is there on the surface. So each one of our funds, every single fund we have, has its own fund page on our website, and that'll tell you the fund's objective. It'll tell you the index it tracks. It has the index methodology, the holdings, the sector, the country weight. So back to Ben's point, if you're looking at, let's say there's two ETFs, and they're both called the Betashares Cybersecurity ETF and the XYZ Cybersecurity ETF. If you just read the name, you'd go, same thing, let's look at the fees. That one's cheap, let's buy it. But as Ben mentioned, there's a bit more to it. It depends what index they're tracking, depends on their holdings. But the great thing is, all that information is really readily available on the various providers' web pages.
That's right. You can check them out right now if you want. Betashares.
Well, don't tune out right now after the webinar.
Maybe open a separate tab and just have us playing in the background, something like that. Okay, Tom, I think it's your turn to answer a question. So, jumping now from ETF mechanics to ETF distributions, we get a lot of questions about distributions. And so there's a couple of good ones here. So, Tom, how would you explain, this is from Scott, by the way, thank you for your question, Scott. How would you explain the vast changes in distributions? For example, he's giving the example of ETHI, which paid a large yield in 2023, and then maybe a smaller yield in 2022, and then a massive yield in 2020. What's going on there?
Yeah, great question. So I'll start fundamentally on distributions within ETFs, and then we can dive into the weeds of FE in particular, like we did with Hack earlier. So distributions in an ETF, they're a source of income for investors. If you're holding an ETF on the relevant date, that ETF will pay you income by way of distribution. That income can come from a few sources. The most common one we think of as investors is from dividend payments. Another source can be from, let's say, options premiums. That's a bit more complex.
Complicated, yeah.
Don't need to bring that up. Now, there's another source of distributions, and that comes from capital gains within the fund itself. Investors sometimes get confused when we bring this up. So obviously, as individual investors, I buy an ETF, I hold that ETF for a period, I sell it, I will realize a capital gain or a capital loss on my position. I'm not talking about that. The fund itself that you're holding, in this case, we're talking about FE. FE itself holds a basket of underlying companies. And when FE has to rebalance, we talked about the rebalancing process earlier on. When FE has to rebalance, it can also realize capital gains and capital losses within the fund. Now, when the fund realizes those capital gains, it's of course a tax event at the end of the year. So those capital gains are generally passed on to investors by way of a distribution. So that means now we've got two aspects to think about. We've got the income aspects, which might be a bit more understandable, easier to predict in a way, versus the capital gain component, which can be harder for an investor to understand or to know when that's going to occur. And so now I'll come to FE as the example. So FE holds a basket of 200 global companies. If you look at those underlying companies, what you'll see is a lot of them don't actually pay very high dividends. Typically, global companies compared to Australian companies don't pay as high dividends anyway. So immediately we could look at that ETF and go, okay, looking at the holdings here, looking at the objective of the ETF, I don't feel like it'll be paying high income because the underlying holdings have high dividends. However, with a fund like FE, on the rebalance, there can be capital gains realized some years, and that's what can lead to high distribution yields. Using 2020 as a particular example, because this is a really good example, in 2020, this is testing me now, in March of 2020, FE held 100 stocks in its portfolio, in its basket, and we, following thorough investigation and chatting with investors, wanted to increase the holdings in FE to 200. So we're going from 100 companies to 200 companies. And I believe in May of 2020, we undertook a rebalance to move FE from 100 to 200 underlying holdings. Of course, whenever this happens, there's ASX announcements, there's a lot of press and release to the investors so they know what's going on. But that meant there were higher than usual capital gains realized that year, which led to a higher than usual distribution yield. Yeah. So it's actually a really good example, Scott, to help explain that.
Yeah, and maybe also as well, it's always important. Don't just sort of look at the latest dividend yield of an ETF and buy it based on that.
Yeah.
Because sometimes it's not necessarily going to be consistent across time.
That's true.
Yeah, so just always be on the lookout for that sort of thing.
Yeah, and I might, in terms of tips, as Ben's just given a good tip, I'd say that two things. First thing, there is the DRP, the distribution reinvestment plan for all of our ETFs. So if you are a growth investor, you want to invest for the long term, you don't necessarily want the income, be it from dividends or from capital gains, you can opt into the distribution reinvestment plan, and those distributions get reinvested back into the ETF. So that's really helpful, number one. Number two, and this is just expanding on Ben's point, if you see a high, distribution yield on a cybersecurity fund, for instance, have a read of the fund objective, and it says, a lot of income funds will say the objective of this fund is to generate higher than usual income. If you don't see that, do a bit more investigating and find out, why the distribution was so high, and is that a reasonable predictor of future distributions?
Yeah.
Fantastic. Thanks so much, Scott. That was a great one. Next one on the distribution front. This one's for you, Ben, from Glenn in all capital letters. Glenn has asked, let me just read this quickly. Is owner of an ETF only?
Is the
owner of an ETF. So as an ETF, the unit holder of ETFs, only on ex-dividend date entitled to the dividend. distribution. So I might rephrase that for Glenn. So
Thank you. I appreciate that. Yeah.
Yeah,
Go.
Essentially what Glenn is asking is, as unit holders in a fund,
yeah,
are the unit holders who are holding the ETF on the X distribution date the only unit holders to receive that distribution?
I see. Okay. Yeah. So good question, Glenn. So yeah, if you are holding an ETF on the X date, you will receive that distribution.
Mm-hmm.
So all holders on that date will receive it. And so I think I'm sort of getting in your head a bit here, Glenn. But it sounds like your idea is, you can buy ETFs just on the X date, just get the dividend and then sell out of the ETF.
Even if that's not Glenn's question, that's a really common question we actually
get. Yeah. And that sort of sounds like, free money. I just get the distribution and
sounds pretty good to me.
There's no cost, but it is important to remember that ETF, the price of the ETF will actually decline on the X date by the amount of the distribution.
I see.
So what that means is if you think about it, it's just an ETF. An ETF is just a fund, right? And as the distribution gets paid out, or as it gets promised to be paid out, which is what the X dividend date is, that money is effectively taken out of the fund, and therefore the fund value will actually decline to reflect that. So what might happen in that instance is, you might buy an ETF on the X date, and then you're eligible for that distribution. But it also means that the unit price will fall by roughly that amount. So you're actually going to be a net balance of zero at the end of the day. And you can actually see this for one of our ETFs. So a high interest cash ETF, the ticker for that is AAA. Because it's just cash, the capital value stays completely stable. But what you'll see, if you look at the price movement over a period of, say, a few months, what you'll actually see is that there's little jumps, little spikes every month, and that little spike is the distribution. So if you imagine the fund is accumulating interest and it all comes into the fund, and then it reaches a peak, and then the X dividend date hits, and then the fund value will drop back to 50. Is it $50, Tom?
It's $50.
It'll drop back to $50 because all of that accumulated capital is being paid out to investors.
Yeah, that's a really awesome example. If you go to AAA's fund page, down to the performance chart, you'll see that. Yeah, really good example, Ben. I think that covers it. That covers it nicely.
Yeah. Thanks for that one, Glenn. So moving on now, I'll just check how we're doing for time, Tom. I think we have maybe do one more of these before we do the quick fire.
Oh, have we got 10 minutes left? 10, 15? Maybe we should jump to the quick fire.
Okay, maybe we'll
answer some live questions as well.
Yeah, okay. We got hundreds of questions, by the way, guys. Thank you so much for sending them in, and we're going to try and get to them all after this webinar. So someone, maybe Tom will be responding to all of the questions that you guys have sent in.
We'll split them.
We'll split them. Okay, we'll do a 50-50. Share the load. Okay, so now we're just going to jump straight into the quick fire section. So we're going to be putting Tom to the test and his investment knowledge here.
This is very high risk, very little reward for me.
Very high risk, and I think the way we'll do it, Tom, is we'll try and keep your answers to around one sentence. How does that sound?
2? You mean 2?
Try and keep it to one.
Sure.
Try your best. We will allow 2 though, if it requires it. So these are just some questions that you've sent in that probably don't need a longer explanation. So I'll just start us off, Tom.
Sure.
Quick fire number 1. Are W8 Ben tax forms required for international ETFs?
No, they are not.
Amazing. How do I find out when an ETF rebalances its stock holdings?
We touched on this earlier. Best place is the fund's index methodology and often in the PDS as well.
Great, which is available on
the fund page. That'd be 2 sentences though.
You're
gonna jump in if I need more.
You got me. How to tell if an ETF has good past performance? What should you look for?
Okay. You can find the fund's performance on the fund's page, but a fund's performance being good or not is relative to what it's actually investing in. So you have to know what it's investing in, know what the expected returns of that is, and then compare like-for-like exposures.
Okay, that's good. I'll give it
a lot of comments in there.
Give it a pass. What additional paperwork is required by an investor when receiving dividends or distributions? Do you receive the full distribution shown on the website if you don't submit additional paperwork?
Sure. So when you first buy an ETF, if it's on your own individual HIN, sign up for Link Market Services, fill out the required paperwork, sentence 1. Then you'll be okay, you'll receive the full distribution. Then come tax time, you'll receive a distribution statement from Betashares through Link Market Services or the Omnibus platform you use to help you with your tax returns. Please go to our tax guide on our website for more information.
Great. When frank distributions are made, are franking credits also distributed to shareholders?
Yes, that's it.
Lovely. Is it better to buy ETFs soon after trading open or rather late afternoon?
Luckily, we touched on this earlier in many sentences. In the middle of the day, avoid the open and close if you can.
And last quick fire question. Does Betashares offer any ETF products linked to US Treasury bonds?
We do. We have a whole suite of US Treasury bond ETFs. You can find all our ETFs on our website under the funds section.
Great. That was it. 7 out of 7, I reckon.
Perfect.
Amazing work, Tom.
I'm safe for another few years between
until our next quick fire session. So I'm just having a look here at some of the questions that you guys have sent in live. Again, thank you so much for asking these questions. Maybe I'll ask you the first one, Tom. This is a pretty good one. So how are distributions calculated? Maybe keep it a bit high level, but how would we calculate distributions for investors?
Exactly right. So and different ETFs will distribute at different times. So you can see on the website, an ETF might distribute monthly, it might distribute quarterly, semi-annually, or annually. And typically, what happens, let's say it's an annual distribution to keep it simple. The ETF's holding, let's say it's an equity ETF, it's holding those companies over the year. The ETF's receiving the dividends that the companies are paying. We also talked about those capital gains and losses before earlier. So at the end of the year, in a simplified example, the ETF will count up all the dividends it's received, all that income. It'll also figure out its capital gain or capital loss position. It'll net off fees and expenses. Those typically come out of distributions. And then what's left over there is what's paid out to unit holders. So let's say there's, just for an easy example, $100 of that distribution to be paid out, and 100 unit holders. Each unit holder will get $1 each.
That's great. Nice and easy.
So that's a good one. Oh, do you want you can run this, Ben. I can't read that fast, sadly. But we can pick these up together. That's an okay one from Samir. At what stage is the ETF fee charged, Ben?
Yeah, a great question. As I think Tom maybe touched on this a little bit, but it's reflected in the value of the fund on a day-to-day basis. So if you imagine, we're just taking out a small amount every day, and so that value over time is slowly being taken out there. And that is being priced into the ETF. So it's not like you're going to get a big invoice from Betashares for your expenses at the end of the tax year. It's all built into the price of the ETF, and so it's just taken out on a daily basis there. So
you can imagine for that A200 ETF with the 0.04% fee, every day 1/365th of that 0.04% is taken out of the fund. So it's a very small fraction, so you don't really notice it. But that's how it happens, because otherwise, if we did it on one day, well, some people who held the ETF up until that day wouldn't have been charged, or if they bought it on that day, they would have. So that's how ETF providers handle that. Great question.
What else?
So we're just scrolling through the all the questions that came through live here, which are all great. I've seen a few, as you look, Ben, a few around when are you paying your distributions, when will I get my tax statement, because it's that time of year, so those are really relevant. Our final distributions for this tax year will be paid in early July, around the 15th, 14th, 15th of July. Tax statements will be available not long after that. As I mentioned earlier, for all those questions, you can go onto Google Betashares tax, and then we have a dedicated page on our website to answer all your tax questions, have a tax guide, and help with all that. Have you found one?
Yeah, I do. This one's a bit left of field, but maybe I think you'll enjoy answering it, Tom. So Mark has come in and he says, my young son is an avid investor.
That's great to hear.
And so the question is, what is the best degree for him to study? So maybe tell us about what you studied at uni and how you ended up in this investing role.
Good question. So actually, I actually didn't strictly study finance at university. I did a commerce degree, majoring in accounting and economics.
Yeah.
So there's some obviously relevance there, but not pure finance and pure investing. That served me quite well. I actually worked as an accountant first, and more recently, well, going on 4 and a bit years now, I've got into the ETF and the investing in the finance industry. And something I found really useful subsequent to university has been undertaking the very, how would I describe it? The CFA program.
Challenging,
rigorous. So that's really helped me in my understanding. But I do know a lot of the concepts in there come from a finance degree. So look, if your son was looking to get into investing, there are a number of angles you can get into it from. But obviously finance is an obvious one. I think economics is a really relevant one too, because particularly with ETFs, I like to think of ETFs as the macro trading tool. You know, you're looking at companies on a macro level. You're looking at the big economic movements. You're not always doing individual company analysis. So from an economic lens, there can be really good advantages too these days.
Yeah.
How about yourself, Ben?
That's great. Yeah, I think that's really good. I studied finance and economics in uni, and yeah,
all bases covered.
Yeah, paid off well. Just conscious of time here, guys. So maybe we'll do 2 more. I've spotted a couple of really good ones here. So Tom, this is just going back to one of your previous answers. Could you elaborate on how market makers price ETF units? Maybe just elaborate on that how piece.
Yeah, sure. So this is from
Elsa.
Elsa?
Elsa. Yeah, right.
Elsa.
Sorry, Elsa. Yeah.
Thank you, Elsa. So there's 2 ways I'm interpreting your question. Either the how is each ETF has a number of units, and the ETF has underlying assets. And simply the price of an ETF, the unit's price, will be the number of assets.
The number of, or the amount of the assets.
The amount of the assets divided by the amount of the units.
The number of units,
The number of units.
Yeah.
So that's how it's priced. Now, obviously, the value of those assets is going up and down all the time. So that's a difficulty in pricing it. Importantly, too, when more ETFs are created, more ETF units are created, more of the underlying assets are also bought. And this is just really important creation redemption process. We don't have time to go over it now. We probably should have covered it in an AMA webinar. It didn't come up. Just Google. We've got plenty of resources online about it. This is a key difference to a company and shares as well. A company at any one time has a limited amount of shares for the ownership of the company. An ETF can create new units. When it does so, create new assets to keep that equilibrium of the net asset value of the price. I think that answers it. The other answer would be around how market makers price it live during the day. And that's more around, it depends how complicated it is. For an Australia 200 ETF, not too complicated, assets are traded at the same time. For cybersecurity ETF, it can be trickier, and they can use very complex financial systems. They definitely studied finance at uni.
Yeah.
That's their IP though.
We've actually, thanks for that. Elsa just said, yes, thank you. It does answer.
Oh, there you go.
It does answer the question. Perfect. So thanks so much for that, Elsa. What do we think? One more?
Let's do one more.
Let's do one more. How about a 000 question, Tom? How do you feel about that?
How does legal feel about that? Yeah, of course.
Yeah, I think this is a good one from George. So the question is, how does a pure commodity ETF pay dividends? How does that work?
Yeah, really good question. So just for context for some of the people on the webinar who aren't as familiar, commodity ETFs are ETFs that give you exposure to a commodity.
Yep.
Now that can be done through a number of different ways. For instance, we have a gold bullion ETF, and that holds physical gold. Well, the custodian holds physical gold. We've also got an oil ETF. That doesn't hold physical oil. There'd be too many barrels for the office we have at the moment.
Yeah.
So that gets exposure through derivatives, through derivative contracts. And it comes back to the capital gain and capital losses I talked about earlier. You know, on rolling those derivative positions, you can realize capital gains or capital losses. And if there's a capital gain position, George, you pay the distribution out as I touched on earlier. That's a nice, I think, high-level way to answer that.
That makes sense.
Yeah, thanks, George.
Hopefully that makes sense, George. Look, to be honest, I've really enjoyed this session, and I feel like I could just sit here answering questions
all night.
All night. And there have been so many great questions. So yeah, really, thank you so much, guys. And we're looking forward to hopefully doing another one of these sort of ask us anything style webinars in the future.
Yeah. And I just wanted to mention, those questions we didn't get to, if you're still on the webinar hanging out, really sorry we didn't get to your question, but we'll be responding to you. We'll send you an email with the answer, and then if you want to have a chat, you can call the retail line and we can chat through it as well.
Yeah, definitely. And then just to wrap up, we just sort of want to talk about something that we've done recently at Betashares. And what we've done is we've created our own investing platform.
Mm-hmm.
So Betashares Direct is the name of that platform. And so the goal of this ETF, this platform is basically to try and give investors frictionless exposure and access to financial markets. And so at the moment, you can download this app from the App Store,
mm-hmm.
from Google Play. You can also actually find it on web, or soon enough, you'll be able to find it on web.
Yeah.
And you can basically purchase any ETF brokerage free. So any ASX listed ETF
mm-hmm.
for no brokerage. Again, trying to give investors frictionless access. So if you want to check that out, all of the details are available just on this page here.
Perfect. I think that wraps it up very nicely, Ben. It was
great.
An absolute pleasure. Let's not wait 2 years next time, eh?
Yeah, that was amazing. I really enjoyed it and hope you guys did as well. But Tom, thank you for being here. Thank you for bringing your investment specialty.
Thanks, Ben. No, glad to share it. Perfect.
Great. Thank you so much, guys. We'll hopefully see you soon.
See you next time.
Bye.